Let's talk about the paradox everyone's feeling right now. Headlines say the economy is okay, markets have rebounded on hopes the US shutdown is ending, and some of the biggest companies in the world keep posting eye-popping numbers from AI and cloud. Yet people feel squeezed, pessimistic, even angry. Flights are being cancelled, prices still feel high, and consumer confidence has sunk near record lows. How can both be true?
Because dashboards only tell you averages, not the lived experience. People don't live inside CPI tables. They live with rents, meat prices, daycare bills, flight cancellations, and news that feels chaotic, and some of those green lights flicker when you look closely. Manufacturing just contracted again. The ISM index slipped to 48.7 in October. The Fed's St. Louis president, Alberto Musalem, says the labor market is cooling and asset prices look elevated. Meanwhile, U.S. consumer sentiment has fallen toward record lows during the shutdown. That's not a vibe. Those are conditions.
Totally fair. Still, there's more resilience under the hood than people think. Look at how markets rallied as Washington moved toward ending the record-long shutdown, funding flows resuming, a clearing of the data fog that had the Fed hesitating, and, crucially, corporate adaptability. Instacart just beat expectations with double-digit order growth. Lattice Semiconductor delivered record communications and computing revenue. Nvidia still wants more wafers from TSMC. Despite TSMC's slower monthly growth, there's significant long-cycle AI demand. Amazon led the Dow on a big up day. Those aren't isolated.
And yet, on the same tape, layoffs at Paramount, 1,600 jobs to save $3 billion. Tyson says next year won't be much better with beef still losing money. While the administration is pressuring meat packers over prices, TSMC's monthly revenue growth for October slowed to the weakest pace since early 2024, which feeds the question, if AI is the locomotive, is it pulling the whole train or just the first-class car? SoftBank sold a big Nvidia stake, $5.8 billion, to double down elsewhere. That doesn't scream straight line up.
Markets climb on imagination, but sometimes imagination becomes real. AI spending is moving from hype to infrastructure. Amazon Web Services plans at least $5 billion in South Korea for new AI data centers. Chip supply chains are reconfiguring. Tooling companies are printing record sales from communications and computing. If multiples look rich in tech, maybe they're discounting productivity gains that aren't fully visible yet. More output from the same workers and energy. Every era of disbelief has given birth to a new normal.
Valuations don't shout, they whisper. The Fed itself flagged elevated house and stock prices in its recent stability report, which Musalem echoed. AQR's Cliff Asness says he doesn't see an AI bubble, but markets give me some nerves. That's the right posture. Skepticism with humility. Leadership has been narrow. AI megacaps, semis, a few cloud names. Meanwhile, breadth, the number of stocks joining the advance, has looked fragile at times, with big dispersion. We've seen this movie. 1999 had a great story too. The story wasn't all wrong. The pricing was.
Let's connect the paradox back to people's wallets. If you own a broad index in your 401k, you've benefited from that leadership directly or indirectly. Even if your company doesn't make chips, the cost savings from AI, routing, forecasting, customer service could show up in margins and eventually prices. Oil is steady, WTI around $60, Brent approximately $64, with Saudi and Iraq cutting official selling prices and Dubai spreads soft. Energy stability helps everyone, and if the shutdown ends within days, withheld federal payments resume, furloughed workers get paid, and airlines can rebuild schedules.
Wallets feel the other side too. If leadership is narrow, index exposure means a lot of your retirement is tied to a handful of giants. If those stumble, even temporarily, your balance can whipsaw. Borrowing costs are still higher than people remember, even if the Fed has started to trim. Musalem said there's limited room to cut rates further. Tariffs are another pocketbook wildcard. The Supreme Court is weighing presidential tariff authority. If the court pushes back, up to $100 billion in tariff refunds could be at stake. But if not, remember what Larry Summers called tariffs, a self-inflicted supply shock that raises prices and slows growth that shows up in grocery aisles and appliance stores.
Fair, but there are offsets. The White House floated a tariff dividend, which Treasury said could effectively show up via tax cuts already passed. Policy still matters for take-home pay, and some inflation is cooling organically. China's CPI ticked up 0.2% year-on-year, but deflationary pressure remains entrenched there. That exports disinflation to the world, cheap goods, cheaper inputs, which gives central banks room to be patient globally. Liquidity isn't evaporating. Europe's FTSE 100 hit a record as US shutdown progress lifted sentiment. Germany's planning industrial power subsidies for energy-intensive firms in 2026 help for margins and investment.
But let's not confuse support with salvation. The U.S. just endured air travel chaos, over 10,000 flight delays and cancellations, because of the shutdown and weather, with air traffic controllers working unpaid. That's a reminder, the plumbing matters. When the government pauses, data pauses, and the Fed has to fly blind. Fed policy, in a fog, means the risk of staying too tight or too loose for too long rises. Markets rarely fall because people panic. They fall because people stop believing. Repeated dysfunction can chip away at that belief.
But daily life says, rent's higher, childcare scarce, my flight got cancelled, my job feels less secure. Even there, we're seeing solutions emerge. World Bank-backed mamapreneur childcare centres in Congo, digital banking units in India expanding financial inclusion, micro-innovations compound, just like the tech story.
Macro still sets the tone. Metals just screamed higher. Silver above $50, gold over $4,100. With copper and platinum jumping over 3% in a single session, safe haven and real asset rallies can signal demand for hedges when investors get uneasy about currencies, policy, or valuations. Oil's steady, yes, but OPEC is loosening to regain market share. U.S. producers are adding barrels, and sanctions are complicating flows. Lukoil declared force majeure at West Corna 2. Hungary got an exemption. Geopolitics can turn energy from tailwind to headwind fast.
This is where diversification, resilience, and corporate agility matter. We're watching companies reroute supply chains, reprice contracts, and automate workflows faster than in past cycles. Even in cyclicals, live cattle rallied hard to close a cash gap, while lean hogs bounced on expected demand for affordable protein heading into holidays. Micro markets adapting in real time, and on the earnings front. While some guides are cautious, others are surprising to the upside. It's not an everything rally, but it's not an everything recession either.
The risk is complacency. Stocks rose on hopes of a shutdown deal. Bonds sold off as yields rose. When the delayed data finally hits after the government reopens, some are warning of a reality check if jobs, wages, or inflation don't line up with the soft landing narrative. The Fed can move cautiously, but Musalem's limited room to cut suggests a shallow easing cycle if tariffs stick or expand, and if AI capex doesn't translate into broad earnings outside the megacaps quickly, you can have a growth scare with valuations still elevated.
On leadership, let's demystify breadth. Breadth is like a choir, are lots of voices singing or just a few soloists carrying the show. The last leg of the rally has had very loud soloists, AI platforms, chip makers, cloud kings. But we've also seen rotation bursts, travel, consumer platforms, even some commodity-linked names when metals pop. If AI is more than a feature and actually a general-purpose technology, the solo will become a chorus as it diffuses into factories, hospitals, and retailers. That's how 1995 to 2005 played out with the internet. Productivity showed up late, but real.
History is useful, not a blueprint. In 1929, profits were improving and radio auto tech was transformative. Didn't stop a crash. In 2007, housing never fell nationally. Until it did. I'm not forecasting disaster. I'm saying today's story has echoes. Narrow leadership, policy uncertainty, foreign deflation exporting pressure, and a Fed that's cut some but can't cut much. Those are thin ice conditions even if the lake hasn't cracked.
Reasonable. But the differences matter. Banks are better capitalized, household balance sheets, while strained by prices, aren't stuffed with exotic mortgages. And corporate America has been surprisingly disciplined with inventories and capex cycles. Plus, some policy moves could be additive. If the Supreme Court curbs tariff authority, you could see price relief and even refunds in the system. If the India trade deal advances, some tariff rate reductions could trickle through to import prices. Macro wins can shift positive, not just negative.
And if the court upholds broad tariff powers, you have a green light for more emergency trade actions. Summers calls tariffs a self-inflicted supply shock for a reason. They push prices up. That's the kind of thing that makes a shopper feel the disconnect. The index says up. The receipt says ouch. It's also why consumer sentiment's near historic lows, even as asset markets levitate. People care less about a record FTSE 100 and more about what beef, eggs, and rent cost today.
But sentiment can snap back quickly when tangible pain eases. If flights normalize, paychecks resume, holidays pass without chaos, and we get a clean slate of data showing inflation steady to lower with employment still okay, the mood can lift. In markets, that kind of relief is powerful, especially when liquidity is ample and cash on the sidelines is big. Retail investors, by the way, are still an important force. Goldman Sachs has called out their growing footprint in US equities. They tend to buy dips on catalysts like a shutdown resolution.
Retail flows cut both ways. They can overshoot on the way down, too. And about liquidity. Yes, financial conditions have loosened, which is part of why valuations are elevated. But loosening can reverse. If the data comes in hot and the Fed sounds more hawkish, financial conditions can tighten fast. Markets are forward-looking. Households are present tense, until the present tense starts feeling better. Lower grocery bills, easing rents, clearer policies. The paradox persists.
Let's paint scenarios for listeners in plain language. Soft landing plus diffusion. AI investment keeps spreading beyond megacaps. Energy stays range-bound. Tariffs de-escalate or courts curtail them. The Fed cuts a little more as inflation drifts lower. Result: broader market participation, real wage gains, sentiment improves. Index investors benefit, and the economy feels better in 6 to 12 months. Choppy middle. Data comes in mixed after the reopening. The Fed remains cautious. Tariffs linger. AI demand proves lumpy. TSMC's monthly revenue growth pace shows that. Result: more volatility, leadership rotates in bursts, and households feel 2 steps forward, 1 step back. Growth scare, tariffs expand or stick, energy spikes on a geopolitical shock, inflation reaccelerates, the Fed can't cut much, valuation nerves meet mediocre earnings. Result: equity pullback, credit spreads widen, job openings fade more visibly, sentiment deteriorates further.
And here's how those might hit wallets. No advice, just translation. If leadership narrows further and then stumbles, broad indexes can be more volatile than people expect because those few names are a big slice of your 401k. If tariffs push prices higher even modestly, households feel it at the checkout faster than wages adjust, especially for meat and other staples already under pressure. If rates don't fall much from here, mortgages, car loans, and small business credit stay more expensive than the last decade's free money era, people recalibrate slower than markets. If a shutdown compromise restores data flow, markets may react to reality, good or bad, more sharply than during the fog. That can swing sentiment quickly.
There's also a quiet positive. The cost of innovation is dropping. Compute is abundant. Open source AI tools are everywhere. Quantum and automation advances are moving from lab to industry. Google just reported a quantum advantage milestone with verifiable algorithms thousands of times faster than supercomputers for specific tasks. These frontier shifts don't fix your grocery bill tomorrow, but they can bend the cost curve on logistics, energy management, and healthcare, things that do touch daily life.
And yet, people can't spend future productivity gains at today's prices. That's the heart of the paradox. The promise is compelling. The present is pricey. The best we can do is be honest about both. Companies are right-sizing, like Paramount. Governments are negotiating, shutdown deal near, tariff cases at the court. And central banks are walking a narrow path with limited room to maneuver. Those are constraints, not catastrophes, but constraints that keep the ice thin.
I like constraints, not catastrophes. It's also why the market's strength can feel alienating. Index highs don't pay your daycare, but they do reflect an economy that, despite political drama, despite deflation abroad, despite supply shocks, keeps absorbing blows and finding new drivers. Even in Asia, where China's deflationary forces linger, we're seeing bright spots. Luxury EVs from Ceres dominating segments, visa-free travel extensions with Japan to boost services, and chip export restrictions easing for European car makers. The world is still adapting.
Adaptation is real. Fragility is too. The shutdown showed how quickly the system can hiccup when basic plumbing stops. The Senate's procedural 60-40 vote is a step toward reopening, and the House could follow. Speaker Johnson called this the beginning of the end. But remember how fast flights were grounded and data went dark. Those frictions erode trust. And confidence, once lost, takes longer to rebuild than GDP.
So why does the economy feel bad even when the data says it's good? Because we've had a sequence of frictions: pandemic, inflation spike, rate shock, political brinkmanship that left scars. Because headline averages can't capture the rent you pay, the childcare you can't find, or the flight you missed. And because transformative technology feels like a story about someone else's job until it lowers your bill or lightens your workload.
And because asset prices can outpace lived experience. When gold is over $4,100 and silver clears $50, it's a signal that many are buying insurance against uncertainty, even as stocks grind higher. When central bankers say valuations are elevated and rate cut room is limited, that's a caution sign. When consumer sentiment tanks during a shutdown, even as markets rally, that's the paradox in a single chart.
My closing take: be sober about risks, but don't miss the deeper arc. Yes, valuations are rich in places, but maybe they reflect a world fundamentally changing. AI augmenting work, energy becoming more efficient, supply chains more resilient, and policy slowly pivoting from disruption to resolution. Every era of disbelief has given birth to a new normal. The feel-bad versus look-good gap can close from both ends, prices easing a bit more and productivity lifting wages more broadly.
And mine: respect the rally, interrogate the reasons. Narrow leadership, policy uncertainty, and elevated valuations mean thin ice. Not thick markets rarely fall because people panic. They fall because people stop believing. Keep an eye on the data that's been missing: jobs, wages, inflation, as it returns post-shutdown. Listen for what spreads are saying about credit, and watch how the AI narrative translates into earnings outside the first movers. That's how the feel will eventually match the look.
Between possibility and caution, that's the balance we'll keep tracking. The story of 2025 isn't over. It's finally getting new data.
And with it, a clearer picture of whether the economy can start feeling as good as the spreadsheets say it looks. Disclaimer: this dialogue is an informational synthesis of the provided news and is not investment, legal, tax, or financial advice. No recommendation or solicitation is being made.